The broadcast is now starting. All attendees are in listen-only mode.
Right, let's just unmute you. That'll make it easier for you to hear me. Hey, welcome everybody to tonight's In the Circle. I hope you're good. I hope you're well. We're looking at volatility and potentially sort of event trading in tonight's session. So delighted to see you all here. And for those of you who made it onto YouTube as well, I hope you're good. We will be resuming normal Wednesday service as from next week. Yeah, it'll be good. Anyway, what we're going to do is what we normally do on these sessions. We're going to have a little look around markets, have a little chat, and then we'll get into the educational content. This is your session, of course, so feel free to ask questions, to make comments, or anything you want to put into the chat box. You're very, very welcome. Let's put up this important message just to remind you that you need to do your own due diligence on anything you see here. This is for educational purposes only, hence you need to make sure that you follow trading plans with anything that you see that you might be interested in trading. Make sure that you manage risk on every trading action. That's on entry and exit. And of course, ensure this is congruent with your own personal trading objectives and financial situation. Massive thanks to everybody who said hello in the questions box already. Thank you very much, Sonia. Hi, Keith. Hope you're good. There's some wonderful people here, some regular attenders I see in the attendee list, and of course some new people. So some relatively new people. So irrespective of whether you're an old timer or whether you're just new and having a wee look at it, you're very welcome. So thank you for popping in anyway. Johnny, good to see you here, mate. I hope you're well too. Right. I'm just going to check in on YouTube and just make sure that everything's working there as it should. It looks as though it is, so that's a good thing. Right, let's just have a look at sort of things that are I've got the market's attention right now. If we just sort of really, the Fed decision has been in focus obviously over the last 24 hours. Good day, Wayne. I hope you're good. Hi, James. So what happened was as was expected and telegraphed and all that sort of jazz, they reduced rates in the US by 0.25%. Some were suspecting half, but the Fed are in an interesting position in that they've got Trump in one ear, and then who wants dramatic rate cuts to try and offset some of the pain that people are feeling because of his tariffs, and the inflationary concerns, which are real. So the Fed have got a little bit of a balancing act to play, and it was a risk management cut, I think is probably the best way of describing it. So if we look at the two mandates, or the two jobs the Fed has to do, first of all, they want to try and keep inflation at a lowish level between 2 and 2.5%. They haven't quite managed that. Inflation is sticky, and in fact ticked up slightly. But the impact of the tariffs is less than they thought. On the other hand, you've got jobs data, which is really quite poor, despite attempts to fudge the figures by sacking stats guys and then rehiring others. The jobs numbers are still pretty awful. The GDP is okay, but not startlingly good. But there are undoubted risks to economic growth as well. So we've got a strange situation where we've got inflation going up, but we've got growth going down. So this is, in terms of the biggest risk, I think the Fed made the call that that the downwards trajectory in growth was probably the slightly bigger risk, and hence cut the rates by 0.25%. If we just look at what's expected, the good news, the markets were very, very twitchy early on after that had been released. If we look at the Fed Fund futures, massive chance of another 4% in October. Essentially, Jerome Powell telegraphed another 0.25% cut next month, and then probably another one this year, and then one early in 2026. So that's what's priced in. So that's what markets are thinking. That's why we had a little bounce on markets. It was a press conference afterwards that sort of telegraphed that a little bit. So we're all good. So that's what's happening with the Fed. And of course, the market should respond accordingly. If we look at what's happening, we'll have a look at charts in a moment. But that's what happened overnight. You can see that really choppy time around the decision, and then subsequently the press conference sort of occurs at around about this sort of point here on the chart. If we look at the futures, looking very positive. These, when we did our live market update this morning, or sorry, lunchtime, Nasdaq was up about 0.6%, up over 1%. Some buying coming in. I did suggest there might be a slingshot when the European markets open. They're also doing good. You can see there DAX and CAC are onto the outperformers, both over 1%. FTSE's a little bit of a laggard. My guess is that they had a rate decision today. Have they done anything? It isn't quite out yet. Australia didn't have a very good day at the office at all, and this is primarily because of this weaker jobs number. So you see, we were expected to add around about 20,000+. We ended up losing jobs, and the Kiwi market also had a little bit of a dive. GDP actually moved to negative territory, so we'll be watching the next figure to see if they are officially in recession or not. Yeah, so interesting. Interesting times without a doubt. Later on, we've got weekly jobs coming out of the US. That's going to be really watched hard. We are expecting a slight drop. If that doesn't drop, markets probably not happy. And if we move to tomorrow, just to prepare you, we've got the BOJ giving us their rate decision, expected to be no worse. There is a thought that they will raise rates in the not too distant future, but it's not on the cards right now. So the press conference afterwards will be interesting, and probably the major market mover on that, unless I surprise everybody, to the Telegraph. So just watch, if you're in the end crosses, just watch tomorrow morning. You just might want to be a little careful with that. So that's the data. Where's the pullback there everybody was expecting? Good eye, David. Let's see here. If we'll quickly look at the just a new little gadget. Anyway, there's the futures. So you can see the where's the pullback? Where's the summer pullback? No sign of it at all. At worst, on the Nasdaq, we dropped 3%. In a retracement, I think this is about 3%. The futures, yep, 3.2%. That was our worst pullback. Normally would expect a correction at some stage. And but you can see there the US futures are going up. Somebody's got their hand up. I'm not sure why. G'day, Roger, by the way. Let me know if there's, just type in the questions box if there's anything going on. There's a US dollar index. What we've got is a bounce off. This level here at around about 96 is a really important level. If you stick this on a monthly chart, you'll see why. Last hit these levels back here in January 2022 to 3-year lows. The US have been tested. But you can see we had a little bounce in yesterday's trading, but then the following candle today is really a rejection candle. You can see we had that was the Fed action there. We had that pop up in early trading today, and now we're just sort of giving it all away again. So we would expect gold to be doing better, and you can see that it is. When we met at lunchtime, it was looking a little bit shaky, certainly range bound. If we look at a daily chart, it didn't look as though we're selling. Looks as though record highs are on the cards again. We'd have to get up to 3,700 is the level to watch on this futures contract. So that's sort of interesting. If we go back to the futures, you can see it's not been a very positive day week in commodities. You can see a drop in oil, in gold, and in copper. Yen is the weaker currency. It's combined into Bitcoin. We'll have a look at a chart on that as well. So that's all good. So commodities. Now, obviously, gold is the big story. We're expecting gold now to push on and move through. If we have a look at the other commodities, quick look at copper. There we go. So copper's pulled back, tested the 200 MA. This was the 50% tariffs for US imports. A move. Since then, we've just crawled our way back up a little bit to that 200 MA. It looks as though there's some reluctance at this stage to push through that. And as I said, oil is looking a little bit shaky. We have been bouncing all over the place a little bit. But we're in this range between about 62 and 64 at this stage. A breach of 62 could see us down to test 60, I would suspect. Doesn't look as though there's much going on in the oil markets at all that's positive. We did get that slight pop-up last week on the back of Israel bombing Qatar, trying to hit Hamas terrorists or the mates, unsuccessfully. Came back down and came back down on at the end of the week. It's in the sort of week this week at all. So those two levels are quite important. A little bit of a scalp trade either side. I don't know if you're really interested, but commodities aren't looking particularly good. Worthwhile having a look at Bitcoin, but it's testing a really important level here. If we look here, we can see that 117, which it's playing with now. If we breach that, we've got two clear lines in the sand, 120, and then those record highs at around about 124. So, yeah. If we get a breach of this, let's just have a look at the hourly chart. I've pulled back a little bit from the highs, but we've got a nice line now. I would suggest this is the level to watch. If we're going to close on an hourly chart, above that, yeah, I'll wait for the hourly. Above this level here, 117,642, that might take us up to 120, and then, of course, there's the next one. Difficult to trade that overnight, of course, unless you're using exit EAs or the like. Just show you this quickly. This is the new dashboard that I'm putting together at the moment. It just needs a bit of tidying up, but and there's options to add some more panels in that. If we look at the Aussie US, it's telling us that the Aussie US is a good currency to have a look at based on relative strength. So let's do that. Let's have a look. Aussie US. It's actually bought into an EA. So you can see they're looking good. We breached this key level at this point here. Just a little pullback there, but it doesn't look as though there's any appetite for selling. If you're not in this already, 67 is a really good level to take advantage of with a potential move to the upside. We were looking at GB pound. No, we weren't. That's an FX scanner. What's this telling us? This is telling us that Aussie yen might be worth a look. Here's the Aussie yen. Yes, it is. And it's much easier than scrolling through 27 charts, isn't it? So we're looking at a breach of 98 there to give us a leg up. One more thing to show you. I don't know whether I've got it on here or not. Okay, there's the ASX top gainers. This is just a new panel I'm playing with at the moment. So these are the ones that do well. We talked about Paladin. Maybe I didn't have it. There we go. So the other way we're doing it is, or the other way I'm doing it is, it's a variation on the scanner, but this is actually strategy orientated. So you can see there. This is a fractal breakout setup. This is a Bollinger reversal setup, pin bar and trend grab. And again, the ideas are the same. So you click through on this, and then you'll get a chart opening to have a better look. So I've already had a look at the Aussie yen. I think I've run out of charts. So if we look at the Aussie yen, so essentially we'll have a new fractal created here. So it's breached a fractal breach there. We've got trend continuation there. That's why that's showing green. Actually, it's on the hourly chart. There we go. Even this looks good for a move up of around about 26 pips at this stage. I'm going to plant my flag. We like the euro yen. We like the euro yen on this. I think it was the euro yen that was our chart of the day on, and it did very well at lunchtime. So if you got in that on a breach of 173.84, you've already clocked around about 50 pips. That's why you should attend lunchtimes if you can. Oh, just make sure if you're on YouTube, just make sure you like the video and click subscribe, and then you get notified. We've got a little bit of a pause. I'm actually doing a little article on inside bar. This is looking like an inside bar potential trade here. So if we get a breach, I would say over 174.47. For those of you less familiar with inside bar, essentially we have a mother bar. And it's the top and bottom. We're looking for a continuation through 174.47. That's the level to watch. Still like this. I still think this could go very high. If we look at the weekly chart, you'll see. Actually, the daily chart's fine. So you'll see that breach of that level and why this move is important. So that's my chart of the day, Euro Yen. Just a couple to watch on the ASX tomorrow. Watch LYC. Did have a good day at the office here. We're looking at 1508 as a potential breach. We also, not Meter Blast. One of my faves, 360 ASS, not surprising, pause around 50. We've got a level of 1512 to signify we've got trend continuation in that after this little retracement. What you've got is that obvious thing. I talked about it extensively a couple of weeks ago. We've got those lower highs. And this just looks as though it's going to be stuck in this upwards trend channel. Once we're through this psychological 50 level, then we'll be away. I think this is a really good stop. Quickly into the US. Nvidia's had a pullback. Is that an opportunity? Well, in extended hours trading, it's doing a lot better than it was in this morning's extended hour trading. We've got to watch this level at 167. If that's breached, could be a short opportunity there, but at this stage it looks as though it's heading back up to 182. But MU were the one I really liked today. If we look here, now you can see there, we've just got pause here around about 158, all-time highs on Micron, pushed through, finished at the high of the day, looking really good. The airlines have sort of got me interested. Potential bounce off of 200 MA for American Airlines. And, of course, Tesla. Every time I have a session, I talk about Tesla, but you can see the extended hours continuing that massive move up. Elon Musk bought some of his own company shares at this point here. This looks as though it's heading up towards that record high at around about 476. Now, the fact that we've breached this level here, it's going to follow through on market open, and that's what's carrying it. We had a little pause here, as I said, at 426. Boom. That's my chart of the day for this evening. Okay, let's just quickly, what else did I put on here? Tariff talk. Tariff talk has settled down a little bit. The Indians are still in Trump's crosshairs. There's obviously possible sanctions heading Russia's way because of their incursion into Poland with their drones. Everybody's getting a little upset with Putin that he's not actually doing anything. But Trump's too busy flaunting with the royal family at this stage in London to be bothered around about tariffs or trade at this stage. Looking at what deals he can put together, I guess. Interesting to see if there's anything that comes out of his meeting with Kim Starmer, if that's his name. But at this stage, it's not really high on the agenda for today, but it could be later. Would you be out of the euro yen before the Japanese news? I would be. Okay, with events that come up, we're going to talk about trading after the event today, but with events, you've essentially you've got two choices. You ride it out. That's always tricky with the yen, particularly the press conference. Secondly, of course, you can close it out. There's possible sense in that, and then you can put a pending order higher than. It depends whether you're up when it happens. It'll be really early morning your time, Shane. When the press conference is, I think the press conference is probably the mover and groover. Or you can, this is why you need the exit only EA. Michael. Yeah. If you had the ability to partial close, that's the other option. Of course, you can partial close some and then trail the rest up a little bit to tighten your stop. Depends what your position as to how enthused you are to get up early in the early hours, mate. But it's not a bad thing. At least it takes them off depending on the size of the position you got. Right. Okay. So just thought I'd have a little discussion about event trading. It's really there's a lot of new traders do it, and a lot of new traders lose a lot of money because of it. It's very exciting. We saw it last night. I mean, if you look here, we got that. Yeah, look, I put my email address if you. Those of you Trader IQ guys, I know there's many of you on here. I'm going to do a session. This is the next stage of that hybrid trading because I've got now an entry only EA as well as an exit EA, as well as all of these tools that you just saw there. To do with the hybrid trading lab is what we're going to call it. Going to develop some more on this. Later. Anyway, let's what I was doing. Okay. Oh yes, I put my email there. So you drop me an email. And again, Trader IQ guys, you can do that. They keep on going up. Still buying coming into the Nasdaq. Anyway, so events act as catalysts that drive sudden powerful moves. Of course, all of that is contextual. We've got massive change in liquidity. We've got sharp price gaps, potentially spikes in volatility, of course. The issue is that retail traders either react too late or they try and guess. Of course, what happens is that it is the severity of the context of the market event in terms of where it is. If we look, for example, at CPI during the pandemic, nobody gave a monkeys. Look at CPI now, and it's possibly one of the key data points. So markets respond in terms of context of the importance of the data at a particular time. Obviously, the level of expectations, theoretically, everything that's known or anticipated is priced in already. So if we have an expectation that things are going to be this number and it's higher or lower, then the market will move accordingly as it recalibrates in terms of what it's thinking. And obviously, there's different types of market event. What's the best EA that I use? It's a great question, Stephen. Can I think about that for a moment? I'll give you an answer before I finish. We had one that sort of trades market events, but I'll talk about that in a moment. Probably one of our best ones is really simple. It's a really simple crossover, same period EMA and SMA. I'll show you later. Bollinger Band's quite nice as well. So it moves out of the Bollinger Band into the Bollinger Band. Gives about depending on the asset you're trading it against, because we alter settings accordingly, but we're looking for in excess of 10 to 1 net profit to maximum drawdown. And some of those, couple of the Bollinger Bands are up at 15 to 1. So that's one that comes in. Obviously, there's the parameters around that. I can show you something before that. If you want to hang on, if you're not actually needing what we do, then outside of this, then we can look at. Anyway, types of market event. This is interesting because one of the things I'm going to talk about tonight, I might actually have a look at in the next program. So obviously, there's the scheduled events. They're predictable. They're on a calendar. We've got what's expected versus, and then we can compare that with what actually happens. And then, of course, we've got unscheduled, such as unexpected shocks geopolitically, government statements, social posts. Currently, or surprise announcements often associated with policy changes, of course. And as I said before, obviously different asset classes react differently as well as so if we look at an interest rate decision, for example, the Nasdaq and the Russell are more sensitive to that than the Dow and the S&P 500. And then there's it's the perceived severity of the data, or the perceived market sensitivity. Move away from what was expected, and the longer term trend. So if we get if we've got a GDP data like in New Zealand, which is just dropping a little bit, dropping a little bit, dropping a little bit, dropping a little bit, or now it's below negative, it is in a downwards trend. And of course, the reason then Kiwi got, let's have a look at that. We didn't actually have a look at that, did we? This was a trade that I talked about earlier today, and it didn't actually happen. So we're talking about it here. And it could have actually bounced to the upside, but it didn't. It actually just pulled back and then trend continuation. Now we've actually got a double bottom on this, which is sort of interesting. And that's because the Kiwi's weak. We're expecting, it's continuing to be weak. We're expecting a rate cut, and so the Kiwi on the back of that GDP number. And so, yes, it does scroll. So it gives a top 10. As I said, I was just playing with this as a concept. And what's your name on one of those panels? So if that Kiwi GDP data is in a downwards trend, not only a surprise in terms of what was expectation, if that trend looks as though it's changed or changing with a number that comes out, that may impact as well. So it's a little bit of a flip your coin sort of event in terms of what might happen. But we're not interested in what might happen. What we're interested in is what happens. And that's the critical point about trading events, particularly the scheduled ones. But obviously the underlying standard volatility, we can't predict either. It's not just the price action itself. It's the volume, it's the volatility, it's what happens next, which is the key thing. So we need a framework. Okay, so we've got essentially a before period where we map out likely scenarios, potential levels, and adjust risk. So those of you who I regularly do sort of CPI live or non-farm payrolls live or rate decision, ASX RBA rate decision live, that sort of thing. And one of the things you'll always see me do is we'll go to a short-term chart. We'll pick out the key asset classes. So we might look at the Nasdaq, go on a 15-minute chart, and we'll identify the key levels. So let's say there was some data due right now, or in the next 10 minutes. What we'll do is we'll put a line here. We'll put a line here. So that's the range it's trading in right now. So we ask the question, what's it going to go to if it breaches that range? Now to the downside, we've got 24.4. We've got about a 55-point drop, and then if we move that down again, we can do that there. Now on the upside, it's a little trickier, of course, because this is all-time highs potentially. So that's a trickiness. So what we can do then is we can do things like we can start to work out, well, look, if this is a range, then some people would say if this is the range here, then you'd expect the same before a stop, same before a stop. Or, of course, we can use pivots. I have a pivot. That's an EA on a pivot, so I don't want that. Somewhere. I need to clean this up a little bit. There we go, pivot calculator. So we can do this. And so we've got our pivot levels there. So we can say, right, okay, you see the R2 pivot is where it's at right now. So our next possible level, if there's a big move, will be R3. So we can actually put those in, or we can use an ATR, our standard ATR. So we can sort of say 22 points is current. So we might put a couple of ATR levels down beneath that. But you need to have a standardization in what you do and how you do it, pre-market. So you've got something to objectively measure as to whether it's any good or not. During, of course, as soon as that data is released, we're going to see a market move, and we need to manage our execution around the potential for hugely high velocity moves, slippage, and of course volatility. And then afterwards, so this is the trickiest part to trade, and it may be that immediately after, or just giving yourself a little space, may allow us to find the cleaner opportunities, if that makes sense. So we'll look at these stages in a bit more detail. I've obviously had a little bit of a drama with the animation here, but obviously we start our day off, if this is a strategy in our toolbox, or our EA. We're now obviously adding economic data to a lot of our EAs or economic data releases. So you could use it at this stage. You're using them for exit, but obviously we can do the other side in terms of say, right, okay, we'll look for this particular move at this particular time. We can obviously grab when that data is due, pick our data points that we're going to be interested in, and away we go. So you either do it manually or automated. So if we look at that, what I'm trying to do is make it easier. One of the things here. So you see here that it's got the data on platform time. Obviously, we're fairly well through the day. If this is the beginning of the day, that would have more on it. Actually, it wasn't a very busy day, but so as I said, you mark potential breakout fade zones, level where stock clusters or liquidity are likely to sit. Now, what do I mean by a fade zone? Well, if we just look at that Nasdaq again, so if we look at a gap strategy, for example, there's two gap strategies. There's one which is a gap and go, and one which is a fade or a gap fill. So if we were to suggest that, so it might be that the trading we're going to try and do is, if subsequent to data we get a breach of this level, up to here, this is potentially our fade point, because you'll find that time and time and time again. Actually, let's just test that theoretically. Actually, it won't work really, will it? Because yesterday's pivots are yesterday's pivots. This is today's pivots. So if we look at yesterday, that would have been the level we would have pre-data we would have identified. So, and then our next level would have been bearish. So what we may have done is we may have said, right, okay, we think there's an opportunity because this is where we're bimbling around at the beginning of the day. No pivots for now. Let's just take those off. Some sort of. So we could have had these lines here, here, and here at this stage. So we saw that drop off back end of the European session into the start of the US. So what we could have said is, look, we're sort of interested in a fade if it gets to this level here. What we mean by that is it sort of gets to that level, and then they say, oh, we've had enough of this already now. So we're looking for a move down to there and looking for a potential opportunity to the upside. Now, the other thing is that 30 minutes is probably too long. But if we look at the 15-minute chart, there you can see it in a bit more detail. So that would be what we'll be looking for, is a move down to this 24.79, then a bounce. So we could have traded this movement here on another failure, or we could have waited for it to sort of zip back up to here, which was our next key level. Or, of course, we could have a Bollinger Band strategy, which said if it moves out and then moves in, we're in, and we could have taken advantage of this. Interesting, we've got to move out of the Bollinger Band, the upper band. I'd be interested to see if this drops off now. Should revert to the mean, which is sort of there, which is about at 24.424. So that's not much of a drop, around about 35 pips. Might see that happening with there being such a run-up. So we have our key levels marked, and we decide, well, okay, this is a key level here. If we're potentially going to trade a fade strategy, it goes up to there, it comes back, and it starts to move back down. if we're trading if you like, a continuation strategy, so initial candle and then continuation, then again, we'd mark those zones, we'd have it all planned out. And of course, we can do that automatically as well. So we already pre-plan our exits, of course, because of the heightened volatility. Depends on how you say your exits. We might be scalping this. We might be and just happy to take a couple of bars that go in our direction, or we might be looking for a continuing trail. And again, an exit EA would manage that for you, even if you're entering it on a discretionary basis, or you just watch it, trail it, trail it, trail it, trail it. And use because the market, because the subsequent candles to maybe, I mean, let's say you looked at the first 3 candles, and I'll talk about a strategy related to that in a moment. But what we would, after those initial candles, and that's why I usually do a 20-minute session for that data, is we'll watch the first 5 minute, the second 5 minute, the third 5 minute candles, and then show you how to adjust stops. If you've not been on one of those sessions, pop along. It's a bit like me being a racing commentator, and we look across various asset classes, but come and have a look if you see it advertised at all. But we need to pre-plan how we're going to manage that. Is it simply going to be a price action trail? What do I mean by a price action trail? Well, let's say, let's just clean this. I'll show you the price action trail. What I mean by that. Let's do that. Okay, so let's say we got in here. Okay, initial stop. Let's say also this is a 1 minute chart, okay? Or a 5 minute chart. You want anything you want. But by a price action trail is, so this, let's say this is our initial trail. As soon as it's done that retracement and start to move up, we put it there. Same. So we're looking for evidence of lower high. So every time there's a new higher low formed, we'd move it to the next level. Move to the next level. Here would probably sort of move it to there. We'd probably be taken out. That's how we do it. That's what I mean by a price action trail. If these are 1 minute bars, you wouldn't mess around. You might even go, okay, I'm just gonna scalp it. So every time there's a new candle, I'm going to take it just below the bottom of the last one. So at this point here, we might move it there. At this point here, we might move it there. At this point here, we might move it there. At this point there, we might move it there. At this point there, we might move it there. So we'd actually get triggered somewhere around there. Does that make sense? Now imagine that's a 1 minute chart or a 5 minute chart, but these are the sort of length of candles that we're trading with here. This has been so hard to trade. Let's just have a quick look at that. It was a press conference afterwards that the market came back. So there was actually a little bit of time, if you're trading the shorter time frame, to do well. Okay here, if you were to trade that first 5 minute bar, again, I'll show you how to make that decision, then you could have done okay, but you wouldn't be messing around here. As soon as you saw that retracement, you'd probably think, oh, right, okay, we're out. So you probably got in here, and I'll tell you why in a moment, and then, yeah. So you might even go to the minute bar after that. So you'll see if you're trading the minute bar, how that might work. Anyway, we'll come back to that later. So you're in two scenarios, obviously, aren't you? I'm in a position and I'm going to have to manage it, or I'm looking for that move afterwards and potentially the opportunities that I may create because of the increased volatility. So you should have, as part of your Shane asked me that question before. So you should have in your exit part of your trading plan. You should have what you're going to do with economic data all laid out in the data. That get over your FOMO, because you can always get back in if it continues in your direction, or do things like partial close or any of that sort of stuff. But you need to articulate that. and have the consistency, and then test alternatives. So during the event, and why we often don't trade the first 1, 2, 3 candles is we get widening spread, we get slippage, there may be odd execution, and as I said, there's two common approaches: a sort of breakout trading approach, and there's a fade trading approach. So we get that immediate overreaction in markets, and then straight away almost we start to get some profit taken for those who are scalping, and those EAs which are scalping also. But the key thing is we're looking for price movement after that initial knee jerk. Okay, the reality is that you've got to have your entry as tight as a drum. Any emotional aspect that pops into your trading doesn't help you here at all. Any hesitation doesn't help you at all. And even consider an entry EA is possible. You can do an entry only EA. Or if you're watching it, you have it fast. And if it doesn't work out, you chop it off. Okay. So, as I said before, the second move often offers the cleaner opportunity, both in terms of potential upside and downside, or whichever way you're going to trade that. So certainly look for mean reversion setups if the market appears to have overreacted. So again, you can just let's look at this. So let's leave it on the 5-minute chart just out of interest. So as I said, you're moving fast. Let's just put some bands on here. Actually, I've done that 1.5. Been playing with different levels at this stage. You might consider, because there we go. Oh, tell you what, let's just get rid of the moving averages on here first as well. I'll give you 2 potential strategies. So if this is your so if this is your SMA, these 2 standard deviations. So the way I might trade this is here we go. Okay, so there are potentially on this 5-minute chart, if you have the plan and the cojones. Okay, we've moved outside. Where is it? Right, that was the first bar. We've moved outside, so we're in here. There's our mean reversion, so we pinch from there. Okay, so signal, entry, exit. You're not messing around with mean reversion here. What you might do is you might say, right, okay, I'm going to trade this on the 1 minute as it breaches that level. And then I'm just going to do that candle by candle on the 1 minute and see how far it goes down. Okay, so that's trade 1. Let's do another one. Okay, so it's outside. That's our signal. There's our entry. There is our touch of our mean reversion. That's trade 2. Give us 3 opportunities this. There's our move out. Now this would be a little trickier because it's almost there. You look at the proximity of your mean reversion, but having breached that middle SMA, you may decide that that's a potential entry there. But this is less, I think, because of the scope that went up. So maybe mean reversion, because it's already there, isn't there, but you certainly would have had 1 or 2 good trades there. In terms of points, let's say you did that, so you got about 35 points there. You've got about 49 points there, so you've done about 100 points on those 2 trades. Just with a simple strategy, it's gone in, so it's gone out, it's come in. We're looking for the mean, which is the middle line there. Now that was a very, very extreme and unusual reaction, but normally you would only get 2 pops, but we nearly got a third. So that was sort of interesting. So you can look for mean reversion, or you can potentially look for breaches. What we'll tend to do, so this is the minute chart, so you can see where the opportunities were in this. If you're trading the minute, yeah, the standard change. So what I did is I changed them to standard. So a 20 SMA and 2 standard deviations. This is always interesting. This would have been a great trade. See how it goes out. It comes back in again. If we weren't taking profit at the mean, or we're using that as a, if you like, that as a trail, we've taken advantage of this move to the downside here. It didn't actually give us another opportunity to the downside because it closed, but there was, sorry, to the upside because it didn't close outside. But you can see there's another one. So we've probably been here. We'll take advantage of this move down here. Certainly, I would be taking it off if it reached the lower band. As soon as it came back up off that lower band, it'd be out. And then we get a couple of small opportunities to the upside on 1 minute. There's one. Back up to the mean. There's one. Didn't quite close outside, so we're not going to claim them unless they're real. Okay, so that's one nice, easy way to play this. Easy from the point of view, it's not hard from an A, B, I do A, I do B, I do C. In terms of the psychological, in terms of the psychology of this, it's not that easy. So we've got one trade, possibly didn't close outside. Certainly 2 trades there to the downside. And then 3, and then 4. So you're looking at 14, another 12. Now that's about 60 move from there to there, and this is about that's about a 70 move down to there. So about 150 pips done, about 150 points doing that, mate. You're welcome, mate. Right, okay, so certainly mean reversion is a possibility if the market appears to look for trend continuation setups. If the event confirms a larger buy. So if you think about it, think of it in terms of a gap type sort of stuff. Now, what we can do with this is, so let's say this is where the data came out. That looks about right, 1630 there. Okay, so that's where the data came out of that line there. Let's get rid of these Bollinger Bands because they're not part of this. So that's where the data comes out. So now we're interested. Now let's say we took, now there's a strategy that's often used, or that traditionally was used in stock markets, but may be useful here, called an open bar range. Okay, and usually what you do is you take the first bar. I think that's too harsh for a data point. So let's say it was this candle here. It might well have been, possibly not got my maths right there. 2030 actually is this bar here. Okay, so it's not this one over here. It's this one here. Okay, so there. So what we might say is we might do 2 bars. Might do 2 bars, or might do 1 bar. Doing let's leave on the 5 minute. So the way an open bar range would work on a market open would be, this is where the market opened actually. 17. So what we'd do is we'd have a start line. We just trade the overall market open, and we do it 3 bars, 1, 2, 3. And what we'd have then is there's our first bar. So there's the high of that 3 bars. There's the low of that 3 bars. So what we're waiting for, okay, so that's this here. So you're almost treating this as a gap for a continuation. So, but what we're looking for is a move outside of this 3 bar range. So we're looking for a move to the downside here on the bottom, or we're moving for the upside there. If we're using the 30-minute bar, we can use exactly the same principle. So if we were to try the start of the day, look at our first 3 bars, 1, 2, 3. So we'd have, there is the high. So we use the wick high, and 1, 2, 3. There is the low. So we'd possibly trade this move here. That wouldn't have been very good, but we would have, as soon as it's moved down to here, would have trailed our stop to here, and so on and so forth. So what we're doing is we're actually trading we're picking a 3 bar, let's say a 5-minute, or maybe a 5 bar if it's a 1 minute, and we're saying, right, okay, if it breaches the range from the top of those 5 bars to the bottom 5 bars, or the top of those 3 bars to the bottom those 3 bars, then we're in. Okay, that's how we may detect a trend continuation. Now, it was a hard call. So let's say we're looking here. Uh, 1830, wouldn't it? Why was that like that point? This is just very hard. You don't normally get this up and down shenanigans going on. I think it was that bar there. So if you were to pick the 3, this would be really hard yards. There would be our first, if you were picking the first 3 5-minute bars, would be in here and get chopped out there. And which the same here, this is really tough because of the, what lot size you use for this sort of training? You start really low, minimum volume while you're learning, or while you're testing out your system. So looking for trend continuation setup, so you can take the range of the first X number of bars, or you can take, what you could do is you could say, right, what's the high? If we were to trade the Asian session this morning, we'd say, what's the high of the US session? Last night it was that, so we for a trend continuation, and we would have actually done not too bad out of that. And again, consistent trail, maybe we would have taken it out there, but if we're in at this point here, we'd have still done okay. Okay. Volume and momentum indicators help confirm whether follow through is genuine. So if we get that, so it's not just a case of does it breach those 3 bars. Let's just bring this closer. Let's look at something else. Let's look at. Okay, so let's look here. Let's clean this up a bit. So let's do a mean reversion first of all. If it's all broke, come back in here. For a 15-minute, let's do a 15-minute. Let's do a 5-minute. So there we've got our move out. We've got our move back in. And then we could have taken advantage of this move here. We've got our move out. That wouldn't have worked out. We haven't got to move back in there yet. So we've taken this candle now, which is the last one out. And now we're going to move back in, take advantage of this move here. This one we would have got caught on. So there's our move in, move out. But you'll notice what you'll notice here. So it depends how you've set up. It did look like a high volume candle, but it didn't close in the top half. So that might be part of your plan. So you would reject that one because it didn't close in the top half. If we're going short, we'll be looking for a close in the bottom half. That one would have done okay. That one would have been okay. That one would have been okay. Probably got caught a little bit on that one. Depends how tight your stop was. Usually we place a stop at the top of the initial stop at the top of the candle that was the one that was outside. That's a logical place to put it. Or even the first candle, or even, yeah, the last candle outside, that would be good. So, but also if we're going to play a trend continuation game, we could use fractals. So here we may sort of say, right, okay, let's just, or zigzags even. Which, and you can use these on the shorter time frames as well. Fractals create slightly quicker. It's a bit of a delay sometimes with zigzags, but you can see here if you'd had that trend continuation strategy even on the 5-minute, there is your zigzag high previous. We could have been in here and taken advantage of that. That would be a candle of interest. So is it in the top half? Yeah. Has it got increased volume? Yeah. Tick, tick, tick. It's over the last zigzag high. Trade that. And this is on a 5-minute. So what I would say is if you're trading longer than a 5-minute, you've got to be looking for longer term breaches. So if we were to trade a 30-minute, for example, that's so hard. So we may be looking at this here. So we're looking at the pre-data zigzag high, and then we might enter here and then trade that to the upside. Really choppy to the upside, but that's a 30-minute trade. Even an hourly would be okay too. So there's the zigzag high pre-data. There's the post-data move, and there is the potential candle of interest there. And we could have taken advantage of that move there. Does that make sense? So we're looking for trend continuation, we're looking for mean reversions, and we're doing it. But it's not just the price action itself, it's the confluence factors that you're looking for as well. And as I say, not a bad idea is to use that. If you use that open bar range concept, but choose X number of bars, you can then pick a high and a low of that, and then a breach out of that suggests a move to the upside. Just watch for proximity of previous movements. What I mean by that is, let's have a look at something else. So if we say, for example, we're going to do this on a 15, we'll take this away from an event. There's the event anyway. Okay. But let's take this away from around and stick some fractals on it. Just to try and show you an example. Okay, so there's a fractal low, there's a fractal low. Okay, so if we were to trade this fractal low here, there's every chance that it might get stuck here. So the higher probability trade would be a breach of that fractal. So it'd be this one here to take advantage of that. Yeah, you're in a candle later, but get over it, and you'll do okay. So that would be a proximity issue, that if you were to enter there, there is potentially a turn point there. So you would have a look here and just say, well, look, where is that compared to this? So if we were to, so again, so here we've got a fractal low. This time we've got no proximity kicking around. There's our fractal low there, so we could get in this candle, and we would probably, it depends how that may not be so successful. But of course, we'd have a stop in there. So the two strategy approaches may be worth referencing, just to highlight that. Apart from mean reversion, a gap type strategies, but instead of a gap, you're using a number of bars and treating that as a gap. So what was it pre-data to what is it X bars after data? And it can be a fill, or it can be a gap and go type sort of thing, of course. And then that open bar range type of strategy, whereby you're looking for essentially a breakout of that range to the upside or to the downside. So either of those, depending on, I think the OBR idea is probably slightly easier. So I would, if I was to plant my flag, just to answer that question, I'd probably do an OBR type strategy and a mean reversion. So have two things. That would be the two ways that are easy to implement, unlike the spelling at the top of this, so apologies for that. Easy to implement, and the other thing about them is they have really well-defined risk management approaches. So if you're using an OBR, what you would say is a move. So let's say you're trading a range of 3 bars and a breach either side. So your obvious risk management would be a move back into that range. So it's a failed break. If you were using a Bollinger Band, then it would be a move back upwards. As I said, I showed you that you'd use that bar to the outside as your initial stop, and then it's just a case of how well do you trail. Does that make sense? Is there any questions you guys have got that I've not answered already? I've tried to answer them as I go. But as I said, with anything, test it out. Jot yourself down some clear strategies, things that you're going to do beforehand, which would be things like put your Bollinger Bands on what anything you might use for your trade actually on your chart. And of course, identify those key levels. If the record highs, then you have to use something like pivots or ATR multiples. Always start off with a low volume, but make sure your trading plan is explicit in terms of being unambiguous. You haven't got time to think, is it or isn't it? It's almost tick, tick, tick in. Okay. And being patient to the end of a bar is worth doing. The other thing I would consider, or from an exit point of view, is tightening your time frame, particularly when there's been a big move. So let's say you've entered on a big move on a 15-minute, then perhaps, or even a big move on a 5-minute, you might sort of look for exits, look for that sort of price action exit that I talked about, that really tight trail to scalp on the lower time frame. Oh, sorry, on the faster time frame. So you might go from 15 to 5, for example, or from 5 even to 1 or 2. Because you can do 2-minute charts, of course, on T5. That's what you don't know. Or you would do customize. You can see there you can do 2 minutes, 3 minutes. You've already got 2 minutes on there, actually. It's sort of interesting. There you go, there's your 2-minute. So there you go. And yes, you could, to answer your question, easy to create an EA out of it. So your key takeaways, look, volatility, changes in volatility give us one of our best opportunities for profit, but also, of course, if we don't manage it well, then one of the biggest opportunities for danger. A lot of scalping strategies don't work because people can't exit as they should, which is why they should automate their exits. Even if you want to enter from a discretionary point of view, consider automated exits. And as long as you have that structure that we talked about, pre-planning before the event, seeing what's happening actually as the data is released, and then giving yourself that little space to take action subsequently is always a good thing. Your job is not to predict the event outcome, but to trade the market reaction. Markets are never wrong. Doesn't matter what you think. That's completely irrelevant. Markets will do what they will do. So what you're doing is it's the purest form of price action trading. And start small, as I've said before. So focus on one type of event, or maybe pick 2 or 3 events, and then do something from there. Build your skill, build your confidence, tighten your trading plan. And of course, you can subsequently, it's your call as to whether you take action from here. Go back and have a look. Go back and have a look at those things that I've talked about today and see if they would be worth looking into for your particular type of trading. And yeah, take the first steps. Write a simple plan. Target 3 to 5 events over the coming week or so. Know what happened. Know what happens when you do it. Did it do what? Did you have a plan that managed it? Not only on entry, but also more importantly, on exit. So it's your call. You can take action from this, or you can say it's not a nice session and have a look at another time whenever it's right for you. As I said, I put the my email in there. There will be a hybrid trading session, just an intro session for those of you who are interested in what we're doing with entry-only EAs, exit-only EAs, all that sort of stuff. Power of the Trader IQ, gang, you'll get an email with that and a short intro video to the concept. If you're not, drop me an email to the Go Markets one and I'll let you know when we're running something for Go. I hope that's given you some food for thought, been interesting, and it's always a pleasure and a privilege to have you here. Thank you very much, Shane. You're very kind. Always really appreciative of any feedback you give me. I'm just going to quickly check in on YouTube. You guys are on YouTube. If you've clicked a like, it would be wonderful. So I'm just going to close that stream down into YouTube. So thank you very much if you attended there. If you go to Go Markets YouTube channel, if you want to watch a replay, you should be able to do it there as well, of course. So we'll see you very soon. For those of you on GoToWebinar, thanks for popping in. It's